Welcome to the Deep Dive. We take a pile of research, connect the dots, and try to give you the core insights. Today, we're looking at a really significant shift in the climate discussion. For years, investment focus was mostly on mitigation. How do we stop climate change? But what we're diving into today is the evidence suggesting that, adapting to the climate risks that are already baked in, that's created this huge near-term investment opportunity. We're talking private capital. So our mission today is really to map that opportunity out for you. And let's just kick off with a headline number from our sources. This demand, this undeniable surge for climate resilience and adaptation tech, it could create, get this, a $1 trillion addressable market for private capital by 2030.
It's a huge number, $1 trillion, and it really signals a necessary pivot in where the money's flowing or where it needs to flow. But maybe before we dive into the financials, it's good to just clarify terms for everyone listening. When we talk climate investing, most people think mitigation.
Right, like reducing emissions,
yes.
Solar EVs, that kind of thing.
Yeah. Exactly, reducing greenhouse gases. What we're focusing on here today is climate resilience or adaptation. This is different. It's about adjusting to the climate effects we expect to see or are already seeing.
So like extreme heat, floods, drought.
Precisely. And taking physical actions to protect assets, prevent negative impacts. Think hardening infrastructure, protecting supply chains, making buildings tougher against extreme weather. It's about dealing with the climate of tomorrow, which frankly is kind of already here.
And you can see why this shift is happening now. It's not some abstract idea. It's hitting the bottom line. The costs are just climbing too fast. I mean, look at the U.S. disaster stats. In 2024 alone, 27 separate billion-dollar climate disasters.
$27 billion events.
Yeah, and at 3 times the annual average from the previous 44 years. That acceleration is just, wow.
And it's global, absolutely. The economic losses are staggering. Our sources point to over $162 billion globally in just the first half of 2025 from climate catastrophes.
$162 billion in 6 months.
Right. And these numbers, they're not just academic. They show this intense pressure from, both the changing climate itself and the fact that we keep building valuable stuff in high-risk areas.
So when you've got that kind of financial pain hitting consistently, the market has to react, right?
It does, and we're seeing it. Big corporate customers, consumers too, they're moving past just planning for resilience. They're actively buying it now.
There was this analysis mentioned in the sources they looked at public communications like earnings calls, investor talks from 200 big companies, S&P 500, STOXX, Europe 600.
Yeah, that was really interesting. What they found was that mentions of terms related to climate resilience, they shot up 55% just between 2021 and 2025.
55%. So that's not just talk, is it?
No, exactly. That's corporate leadership recognizing, okay, resilience isn't just a nice-to-have ESG thing anymore. It's fundamental to operating.
And alongside that corporate chatter, you have these really loud signals coming from finance, especially insurance.
Oh, definitely. Insurance companies track risk better than almost anyone, and they are basically shouting warnings.
How so? What are the numbers?
Well, look at the U.S. Tenants and Household Insurance Index. That's, basically what you pay to insure your home. It grew 3 times faster between late 2022 and mid-2025 compared to the 7 years before that.
3 times faster.
And in really exposed areas. Florida, the signal is even stronger. Average annual home insurance premiums there jumped about 55% between 2020 and 2023. We're talking averages hitting like $3,500 a year.
Ouch.
Right.
Yeah.
Insurers are effectively saying, look, you either invest in making your property safer or the cost to insure it is going to become unaffordable.
So that pressure, it's actually leading to people spending money on the ground.
Yes, absolutely. We're seeing real spending. One of the strongest indicators the sources highlighted was the adoption rate of the Fortified Construction Standard.
Okay, tell us about Fortified. What is that exactly?
So Fortified is basically a set of standards for making buildings more resilient, particularly against hurricanes and severe weather. Think stronger roofs, better window protection, that kind of thing. It's a practical blueprint for adaptation.
And people are actually doing that.
They are, and fast. The number of buildings using the Fortified standard actually doubled between 2019 and 2024.
Doubled in 5 years.
Yeah, and the growth is picking up steam. There was a 30% increase just between 2023 and 2024, and get this, new applications to use the standard jumped a record 160% in that same 1-year period.
Wow. So homeowners, businesses, they're putting their own money into hardening their assets?
Exactly. And it's not just buildings. There was a quick example in the sources about a U.S. generator supplier. They saw an 18% jump in residential sales from 2023 to 2024.
Because of power outages?
Directly linked to more frequent severe outages from storms. People are buying backup power. They're taking resilience into their own hands, spending money now to avoid disruption later.
Okay, so the demand is undeniable. It's being driven by these immediate financial pressures.
Yeah.
But if this market is so big, potentially $1 trillion by 2030, why is private capital, the big institutional money, seemingly just waking up to it?
That's a great question. And it's because historically, resilience was seen mainly as a job for the public sector, governments, development banks. They led the way. In 2024, something like over 85% of all the money going into climate resilience came from those public or development finance sources. Private capital, only about 11%.
11%. And the sources said, less than $8 billion had been raised for dedicated private climate resilience funds globally by mid-2025.
That's right. Less than $8 billion.
That seems tiny compared to the need, and especially compared to that $1 trillion opportunity figure. Is it just too early, or is the risk profile weird?
Well, that's the gap, right? And that's why this feels like an inflection point. The private capital gap is huge. You compare that $8 billion for resilience funds to the over $650 billion raised for decarbonization, for broader sustainability, it's night and day.
So why the gap?
Historically, resilience projects often lacked a clear investment framework. It was harder to quantify the returns compared to, say, a solar farm. But that's changing. That framework is emerging now, and that's what the sources mapped out. By focusing on 49 priority technologies across 10 specific categories, investors can tap into that $600 billion to $1 trillion market by 2030. This is the roadmap.
Okay, this is where it gets really practical. Let's break down those 10 categories. Where are the biggest opportunities?
Right. The absolute giant, taking up almost half the potential market, is resilient buildings. The estimate there is $400 to $500 billion by 2030.
$500 billion.
Yeah.
Just in buildings. That's massive. What kind of tech are we talking about there?
It's pretty broad. Think energy-efficient HVAC systems that can handle extreme heat waves, different kinds of heat pumps for shifting climate zones, and just the physical hardening of the buildings themselves, stronger roofing, impact-resistant windows, things like that. It's making structures fundamentally tougher.
Survival architecture, as you said earlier.
Okay.
Okay, what's next biggest?
Next up is grid hardening, protecting our electricity infrastructure. That's estimated at $175 to $200 billion.
Makes sense. We need power.
Exactly. This includes things like battery storage, microgrids, and smart grid tech that helps manage power flows better and isolate problems quickly during storms or heat waves.
And then, logically, resources. Agriculture seems like a big one, too.
Huge. Resilient agriculture is pegged at $130 to $200 billion. With growing seasons becoming so unpredictable, this is crucial.
So what does that involve?
Things like advanced farm management software using climate prediction, much more efficient irrigation systems, and biological products, biostimulants that help crops survive heat stress or drought.
Right.
Basically adapting how we grow food.
Then you've got water infrastructure, another non-negotiable, really. Looks like $140 to $160 billion.
Yep. Everything from advanced wastewater treatment to desalination where needed, and smarter ways to capture and manage rainwater, dealing with both too little water and too much.
And keeping things moving. Logistics and supply chains need adapting to. That's $145 to $165 billion.
Right. As storms or heat disrupt transport routes, we need better cold chain logistics, keeping things cool, and specialized containers that protect sensitive goods like medicines, no matter the delay or outside temperature.
Okay, so those are the really big ones. Buildings, grid, ag, water, logistics. What about the other categories? Still significant money involved.
Absolutely. They offer more specialized plays for investors. You've got disaster prediction, prevention, and recovery things like better weather forecasting software, emergency management platforms. That's $80 to $100 billion.
Oh, wait.
Then healthcare and livelihoods at $80 to $110 billion. This includes things like remote healthcare delivery, especially after disasters, and public health surveillance to track disease outbreaks.
More specialized areas.
Yeah, like wildfire and vegetation management, $35, $40 B. Think analytics to predict fire spread, tech for restoration after fires, and flood management, $25, $30 software for stormwater modeling, emergency flood response services.
And the last one mentioned was financial risk transfer, $25, $35 PMS. You mentioned parametric insurance earlier. Maybe quickly define that for us?
Right, parametric insurance. It's really clever for resilience. Instead of a long, complex claims process after a disaster, it pays out automatically if a specific pre-agreed trigger happens.
Like what kind of trigger?
Could be wind speed reaching a certain level in a hurricane, or rainfall exceeding a defined amount, or earthquake magnitude hitting a threshold. The point is, the payout is fast based on the event itself, not the detailed damage assessment.
So it gets money for recovery out much faster.
Exactly. Speeds up recovery, cuts down bureaucracy. It's a key financial tool for resilience.
Looking at that whole list, what really strikes me is the diversity. The $1 trillion isn't just one thing. It's hardware, software, materials, science, finance, services.
Spot on. It's incredibly varied, which means lots of different entry points for different types of investors.
Okay, so the opportunity is mapped out, it's diverse, it's potentially huge. But how do we get from that, well, relatively tiny $8 billion in dedicated private funds today to actually deploying capital at the scale needed to capture that $1 trillion market? The sources seem to point to three main priorities for investors. What's the first one?
The first one is absolutely fundamental. Financial institutions need to get much better at modeling the return on resilience, or ROAR.
Return on resilience.
Yeah. It's about moving beyond just calculating the risk, like what's the potential cost of flood damage to this factory, to actually modeling the return on investing in protection. So you need tools to quantify that value at risk and then model precisely how much that risk is reduced if you, say, build a flood barrier or upgrade the roof. What's the net financial benefit?
So basically proving mathematically that spending money now on resilience saves you more money later by avoiding damage and disruption.
Exactly. Investors need to see that clear, calculated business case. The ROAR makes resilience investable, not just necessary.
Okay, that makes total sense. You need the numbers. What's priority number two?
Priority two is about creating structural incentives. We need financial innovation that shifts the focus from just paying out after disaster reactive relief to funding things that reduce the risk before the disaster happens, proactive reduction.
And are we seeing examples of that happening already?
We are, yeah. Some really smart examples, like FM Insurance has this resilience credit program. They actually give policyholders credits, effectively discounts, for making specific investments to reduce their risk.
So you get rewarded twice, you're safer, and you pay less for insurance.
Precisely. It's a direct financial incentive to invest in hardening your assets.
Any other examples?
Yes, these performance-based bonds are really interesting. The Forest Resilience Bond, FRB, is a great case study. Private investors funded proactive forest thinning and restoration work in California, basically reducing wildfire fuel.
Okay, and how did that pay out?
The pilot project fully repaid investors in 2023 because the work successfully lowered the risk of catastrophic wildfires, which benefited downstream stakeholders like utility companies and water agencies, who were beneficiaries of that risk reduction. So investors made money by preventing a disaster.
That's brilliant. Profiting from prevention.
It is, and we're seeing this kind of thinking scale up. Barbados did a groundbreaking debt for climate resilience swap in 2024.
How did that work?
They basically converted some of their existing higher interest government debt into new loans with lower interest rates, but with the condition that the savings, about $165 million, would be dedicated specifically to funding local climate adaptation projects, using national finance tools for resilience.
Wow. And even at a smaller scale.
Even locally. Programs like PACE, Property Assessed Clean Energy, are being adapted. In Florida, for example, they're expanding PACE to let homeowners finance hurricane hardening upgrades through long-term additions to their property tax bills.
So it spreads the upfront cost over many years, making it affordable.
Exactly. It shows resilience finance is becoming a real flexible asset class.
Okay, so quantify the return, create incentives. What's the third priority?
The third is about capacity and knowledge. Build specialized capabilities. The big long-term investors, pension funds, sovereign wealth funds, they need to develop dedicated expertise in this area.
Why is that?
Because underwriting resilience investments is complex. You're not just evaluating a building. You might be evaluating ecosystem restoration benefits or the effectiveness of a digital monitoring system for predicting landslides. It requires new skills.
So integrating climate risk models directly into their investment process.
Yes. Very accurate climate risk models, and they need the technical insight to judge whether these diverse solutions will actually work. This means collaborating much more closely with, say, engineering firms, specialist insurers, materials scientists, people who really understand the physical risks and solutions. #tag outro. So I think the main takeaway here is that this climate resilience opportunity, it's real, it's substantial, and it's incredibly diverse. It touches everything from software code to concrete barriers. We're really talking about establishing resilience as just a core part of long-term value creation for companies, for infrastructure, for governments, really.
Yeah, it feels like a fundamental shift. But getting to that full trillion-dollar potential, it won't happen automatically. The sources emphasize that collaboration is key, private sector, public sector, philanthropy, all working together. Especially because there are still tricky challenges, right? Like significant data gaps in tracking how well these resilience measures actually perform over time. How do you prove that a new seawall prevented X million dollars in damage 5 years later?
Exactly. And we need more standardized ways to measure and quantify those avoided losses. That standardization is crucial for building investor confidence at scale.
Which brings us back to the core challenge for investors you mentioned.
Right. We know the demand is there now. The market opportunity is clear today. But the long-term success, the real scaling of this as an asset class, it hinges on getting better and better at predicting and pricing the future value of avoided loss. And that's a fascinating metric because it blends financial return with, protecting lives, preserving communities.
So that really leaves us with a final provocative thought for you, the listener. We're entering a world where financial markets are increasingly being asked to put a price tag on the value of something that didn't happen. The insurance claim never filed, the business interruption avoided, the disaster averted. How accurately can markets really price the value of a disaster that never happened?